Hi, everyone, and thank you for joining us for Cherry Bekaert's 2022 Year-End Tax Planning for Businesses webinar. My name is Maddie Robbins, and I am our production manager here at Cherry Bekaert. The team has a great presentation lined up for you today, and we will be offering 1 hour of CPE for this session. Now, before we get started, we have some quick housekeeping to address. To receive CPE for this session, you must answer at least 3 of the 4 polling questions and attend for the full 50 minutes. CPE certificates will be issued via email within 10 days. If you have not received yours after 10 days, please email cbhlearning@cbh.com. A recorded version of this webinar will also be available in about a week and will be sent via email and posted to our website. Now, if you have any questions during the webinar, please type those into the Q&A box down at the bottom of your screen. Just note, we will also be sharing a short survey at the end of the session. We value your feedback and just ask that you take part. Now with that, let's go ahead and get started. I'm pleased to introduce Sarah McGregor, Director with Cherry Bekaert's Tax Practice, along with tax partners Kat Baisley and Greg Davis. Please, Sarah, take it away.
Great. Thank you very much, Maddie. Welcome, everyone. We appreciate your being here and joining us for this session today. We're going to divide this up into about 15 year-end tax topics. Some will be brief, some will take a little bit longer, and some of them, of course, as I read out, trying to make the total of 15, will include a bundling of a few ideas. So just wanted to let you know that this is kind of the area that we're going to be covering and things we're going to be talking about as we move through planning ideas, things to keep in mind, what's new and different for 2022 and 2023. So let's go ahead and get started with that. Greg, kick us off by talking about some key important differences between 2022 and 2023.
Absolutely. Thank you, Sarah. First topic we're going to touch on is the Code Section 163J Business Interest Expense. This has been in effect for quite a few years now, and if you've had to work through this, you're certainly aware of what the calculation has been. As a reminder, this affects companies with greater than 27 million in revenue and companies that are deemed tax shelters. Real estate's been predominantly pulled into this via the tax shelter. As a reminder, that is a company that has or allocates 35% or more of its losses to limited partners. So what's changing between 22 and 21? Essentially, your interest was limited to 30% of adjusted taxable income. Previously, that was calculated as taxable income. You got to add back interest, depreciation, and amortization. Starting in 2022 all the way through 2026, it's going to fall off the depreciation and amortization piece of this. So it's going to significantly increase the add back for a lot of companies. With that said, real estate companies should definitely consider the real property trade or business election if it hasn't already been made. And for all other companies, they definitely need to address this before year end so they don't have any surprises. So research and development costs. Big change for 2022. We now have to capitalize and amortize all of our R&D costs. You get a 5-year amortization period if the research is done within the US, and you get a 15-year amortization period if any of this is done overseas. It's an automatic accounting method change effective as of January 1st, 2022. This is probably going to catch a lot of companies off guard. Hopefully your CPA has brought this up with you. If not, you're going to want to do a deep dive between now and year end, determine what your 174 costs are. So your 174 costs are going to be much larger. These are all of your research and experimental costs, not just the ones that are going to qualify for the R&D tax credit. Those are much smaller. So keep that in mind. I will note that there's been bipartisan support for legislation to effectively allow the continued expensing of these costs, but there's no guarantee that that's going to happen between now and year end. A reminder regarding bonus depreciation. This is going to be the last year that we've got 100% write-off of bonus. Going forward, it's going to decline by 20% per year. So 2023, we get 80%. Every year between now and 2027, it's going to decline by 20% until it hits zero. So anybody who has net operating loss carry forwards, these can now only be carried forward. You previously could carry them back. Any NOL that was generated in 2018 or later can only offset 80% of your taxable income. And any NOL generated 2018 or before could still offset 100%. And there are ordering rules to this. All of those old NOLs pre-2018, they come first. And anything post-2017, they can only offset the 80%. Those come secondarily. And I think with that, we're going to our first polling question.
That's right. And Greg, as you were talking about that 80% bonus depreciation instead of 100%, choosing whether to place an asset, acquire it and place it in service before December 31 of this year will be very important for folks to consider that trade-off between additional depreciation deductions or in the current year, or losing some of that immediate next year as well. And it's just going to complicate the state reporting for depreciation, which may have its own rules as well. All right, Maddie, are we good with the polling question?
I'm going to give it about 10 more seconds. So if you have not answered, this is your opportunity to get that response in.
Great. And this is a helpful way to think about whether your company is engaged in research and development. It's about working on new products, new processes, and even in some developing software. All right, good results there. Thank you. And we will move forward. Kat, talk to us about what's going on with pass-through entities.
Okay, good afternoon, everybody. I'm Kat Baisley, a tax partner. Before I discuss pass-through entity elections, and Sarah's probably freaking out because I'm going off script, I am in Miami for a conference. So hello from gloomy, rainy Miami. And if any of you listening are down here, another Cherry Bekaert partner and I are here and may need lodging because our flights are being canceled and the hotel is full. So feel free to drop your contact information in the chat. And now on to the pass-through entity election. At the end of 2017, the Tax Cuts and Jobs Act, TCJA, introduced the limit to the deductibility of state income taxes at the individual taxpayer level. Taxpayers in high rate states have been significantly impacted by this, as state taxes are now limited to $10,000. Previously, you could take whatever you had for property taxes and income taxes. So the pass-through entity tax election has been created to combat this. 39 states and New York City have enacted this election, and they're taking two approaches to how to treat the entity level tax. Some states are allowing the owners of the entity an income tax credit for their share of the state tax that's paid by the entity. And some other states are reducing the owner's state tax income by the amount reported and taxed at the entity's level. Very, very critical to the pass-through entity election is making the payment of the tax by year end. Please, please do that. We would hate for you to lose this opportunity. Now, there is some planning that can be done around the pass-through entity election. Some of the planning relates to the owners and some relates to the rules around the specific elections. As far as the owners are concerned, you want to look at who the owners are, where they reside, where the business is, because the pass-through entity election could be extremely beneficial for one owner and detrimental for another. So you don't want to blindly make an election or think that, yep, it's a great idea, let's go ahead and do this. You want to make sure you identify any conflicts of interest before making the election. Your partnership operating agreement may need to be amended in order to do this. And something that a lot of people aren't thinking about is that shareholder distributions will need to be monitored for this, because the tax that's being paid on behalf of the shareholder will be treated as a distribution. Another important planning tool around the pass-through entity election is the rules on how the election is made. It varies by state. Unfortunately, tax is never cut and dry and easy. It varies by state. It varies by the type of business or activity that the entity is engaged in. Some states, it's a one-time election. Sometimes it's made annually. In some states, the election can be revoked. Some, it has to be made prior to year end. In some states, it applies to all of the owners. Other states allow owners to pick and choose whether or not they want to be part of the pass-through entity election. So there's a lot of information that needs to be taken into consideration when determining if the pass-through entity election will be beneficial. And we have a very strong state and local team that can assist with this. They have some great planning techniques around this, and I would strongly encourage you to reach out to us and we will get you connected to them to help you save some money. Another item related to pass-throughs that we wanted to discuss is the K2, K3. Forms K2 and K3 are schedules that were introduced with the 2021 tax returns that were intended to provide transparency and clarity for owners of pass-through entities regarding how to calculate their U.S. income tax related to relevant international activity. These forms are used to report income, deductions, credits, and miscellaneous items. The forms, not surprisingly, are cumbersome, not terribly clear on how to report certain items. And last year, for the 2021 returns, there were some big holdups with e-filing. So there is some relief, some. If you have international activity or foreign members or shareholders, you don't get that relief, sorry. But for those of you that do not have international activity or foreign shareholders or members, there is a set of criteria that will allow that entity to be exempt from filing the K2 and the K3. One very important criteria piece is that the entity must inform the owners that it does not intend to file the K2 and the K3 unless requested. So that is something that could potentially save a lot of time with your tax preparation, but the entities will need to be proactive about reaching out to your members in order to take that exemption.
Right. And Kat, these are just still draft instruction forms,
yes.
But we are very hopeful that this will be the case once the forms are finalized.
Yes, it better be. Okay, the IRS and their audit campaigns. I know it's something that everybody loves to hear about, but the IRS has announced certain audit campaigns that are on their radar and that they are focusing on. In the S Corp world, they are looking at distributions. Within that bucket, the first item that they're looking at is when an S corporation fails to report the gain upon the distribution of an appreciated asset to a shareholder. And when people think about that, they are often thinking about something that's had some great big appreciation, a building, or an entity that the S Corp may own. But it could even be something like stock. Publicly traded stock, think you bought it for $100, now it's worth $1 million. That distribution is going out at $1 million. Just be mindful of that. The second issue that occurs is when an S corporation fails to determine that the distribution, whether it is cash or property, is properly taxable as a dividend. And the third issue is when a shareholder fails to report non-dividend distributions in excess of their stock basis, because those distributions that are in excess of tax basis are subject to taxation at the individual level. Another area that the IRS is focusing on is partners in partnerships, specifically those that claim to be limited partners. Unless an individual is truly a limited partner for self-employment tax purposes, that partner or members distributive share of income is subject to self-employment tax. A lot of members and partners, including service partners in partnerships that are organized as limited liability partnerships or limited partnerships or LLCs, have inappropriately been claiming limited partner status and not reporting that income as subject to self-employment tax. That is on the IRS's radar. And finally, another item that they're looking at is the sale of a partnership interest. The reason they are looking at this is because oftentimes when someone sells a partnership interest, it is treated as a capital gain and they're getting long-term capital gain benefits for that and tax reporting. But often a portion of that gain should be taxed at ordinary or 25 or 28% rates. There's something called hot assets. The point of this being that they are now looking at this, and you need to ensure that if you sell a partnership interest, that you're looking through to what the assets of the entity were. Okay, claiming pass-through losses. Of course, this is much harder than it sounds, or it's actually much harder than you would think. It's one of the most complicated pieces of partnership taxation and pass-through entity taxation. When claiming a loss from a pass-through entity, there are 4 different hurdles that must be met before claiming that loss. First, you have to look at your stock and basis limitations and what you have or don't have. That is much easier to determine with the change in the K-1 reporting that has happened over the last couple of years. Then you have to look at what's called at-risk limitation, and that's whether or not you are typically on the hook for some debt of that pass-through entity. Then you have to look at your passive activity loss limitations, and that looks at your participation in that particular entity or a group of entities. And finally, you have to look at what's known as the excess business loss limitation. And that is something that, you know, historically, if someone lost $1 million in their business and had $200,000 of wages and they were active in that trade or business, they could net that amount. They'd have a loss of $800,000. They'd end up with a net operating loss. Now that loss is limited, and for married filing joint, that is $540,000 for the current year, and any losses in excess of that will be carried forward. So they're not lost, but they are deferred. And it's important to keep that in mind because from a cash flow perspective, your entity has likely lost money. And on that uplifting note, Sarah, I'll pass it off to you.
Great. Well, let me talk about some good news then. The Inflation Reduction Act of 2022. This was signed into law in August of this year, just a few months ago. Most of the provisions in this law do not take effect until January 1 of 2023, but we find it's important to go ahead and talk about it now because it may affect some of the decisions you're making in the last quarter of the year or you're planning for next year. There were 4 revenue raisers in this law, most that will not in fact impact many businesses, but they will impact some very significantly large businesses. The really bright spot in this is the multitude of clean energy tax credits, incentives, deductions that are allowed in there that are offered in this bill. Some refreshing existing credits and incentives, and some offering brand new credits to taxpayers. So we're just going to hit some highlights here, please. The law is very complicated, and the IRS is just now asking for input as it starts to build its guidance on these new rules. So a couple of things that were existing already. Section 45L, this is in the home construction business area, and this was expanded. This is a credit that's allowed, $1,000 per unit. You think about an apartment building that can be used for this, or condominiums or home construction, single-family home construction. This has now been expanded to include more buildings. There wasn't a height restriction on this building. That has been removed, and it has been extended through 2032. Section 179D, again, for builders and for architects and engineers and others that are designing and developing energy efficient commercial buildings. This has now been modified to apply not only to new construction, but also what is new is to some retrofitting of existing buildings. So there will be I think it's an every 3-year look back to see what have you done to a building or acquired a building and made upfits for energy efficiency in it. And if it meets certain criteria, you'll be able to get, in this case, a deduction rather than in lieu of a credit for this particular item. Section 48 was an existing credit for energy investments. This is now in place again. There are some incentives in here to help build wind facilities in low-income communities, housing project areas, tribal land agreements. So you may see much more in the news. I think there's already been $1 billion of announcements of activity to invest in these areas. So you may see more news about this. We'll talk about how the credit can be boosted later in this presentation. Some more new credit or some existing credits, the alternative fuel vehicle refueling property, think electric chargers to charge vehicles. There's a 30% of basis credit allowed. The overall credit limit is $200,000. But if you are thinking in terms of places around your building to encourage electric vehicles and provide that refueling option, know that there is a credit available to you to build into your expansion design plans or into any work that you're doing on your existing facilities and buildings. A new credit that came through is the qualified commercial clean vehicle, section 45W. This is now for your electric fleets. It is for trucks. It is for more significant size vehicles. The credit is up to $7,500 for vehicles with a gross vehicle weight under 14,000 pounds and up to $40,000 for heavier vehicles. So those commuter vehicles, the buses, the trucks, light trucks, all of those things that can be either a plug-in or all electric are now going to, and as well as fuel cells, are going to be eligible for this credit. Again, this is for vehicles acquired and placed in service after 2022. So next year, if you're looking to replace some fleet vehicles, if you're looking to expand your vehicle pool, this may be an area to think about. Few more new credits, the advanced manufacturing production credit. So if you are in the business of producing components or refining and identifying critical minerals that are being acquired, so solar energy components, wind energy components, inverters, batteries, all of that, there are new credits available for those that produce those goods that are going to be needed to, as all the companies try to install these on their buildings or add these components to their to their buildings and to their business locations. Section 45E, credit for investment in energy storage technology. This is developing new batteries, new ways to store all of this clean fuel, as well as we see the credits for producing clean hydrogen, clean electricity, and clean fuel that are included. Okay, let's talk about boosters. So what was new and unique in this is an ability to take a 6% credit and boost it up to 30%, or take $1,000 credit and boost it up to $5,000 using these guidelines. And sometimes the guidelines vary, but basically the boosters need to be paying wages at prevailing rates. There must be an apprenticeship or an apprentice program attached to the project. And sometimes there are some domestic content requirements. Third, there are occasionally requirements that the activity occur in low-income communities, in housing projects or connected with housing projects, and sometimes in what they're calling former energy communities. That is, communities that were near, say, coal fields or oil refineries or, old fuel source or traditional fuel source programs that we're trying to move away from. If you put a new battery plant near an old coal field, then that's the kind of project that would help to boost the credit up and bring it to a higher level. It is going to be interesting, particularly on the home construction projects, on the commercial building projects, to make sure, if you're a general contractor, to make sure all of your subs are paying wages at prevailing rates, and make sure that you and all of your subs have apprentice programs in place in order to maximize this booster. We're not sure what is a prevailing wage at this point. We're not sure what qualifies as an apprentice program, but the Department of Labor and the Treasury will be putting forth guidance, and they've asked for input in these areas. Startup R&D credit. So the research and development tax credit that is available for startup companies, that is those companies that have had limited or no gross receipts. They're not in the business of selling a service or a product yet. They're still working on it. But while they're working on it, they're paying lots of wages to engineers and scientists and computer programmers and others that they need to develop their product and develop their idea. And so the ability for a company to take their R&D credits and reduce payroll taxes for a period of up to 5 years has been increased under Inflation Reduction Act from $250,000 maximum amount to $500,000 maximum amount starting January of next year. Also, the credit can now be used to offset both the employer's FICA share and employer's Medicare share of payroll taxes. And I think that brings us to polling question number 2, if you want to go ahead and get that one up for us. So the question here, of those provisions in the Inflation Reduction Act, which do you think will benefit your company? Those credits for existing credits and incentives for construction and building, the clean vehicle credit, R&D credit for startup, the credit boosters where you can raise something up, or not quite sure.
And Sarah, I don't know if we want to take a second once people have answered the polling question to answer some of the questions that have come into the chat.
Okay.
One question that we've gotten is, for accrual basis pass-through entities, does the tax still have to be paid by year end? And how does the tax get calculated by year end?
Great questions.
Yeah.
So if you want to stay within the ability to deduct the taxes is solely reliant on a notice 2020-75 from the IRS that was issued 2 years ago, where they said, we're going to issue some proposed regulations. And within that notice, they said that they did not use the term taxes paid and accrued. They said taxes, tax payments. So if you want to be sure and stay within that, which is not usual. I mean, usually it's paid and accrued taxes. It's not just paid. But if you want to stay within within that frame of the notice, then making the tax payments before December 31 is the best way to go about this. Kat, you want to talk about how you deal with clients that are trying to figure out how much to pay by year end?
Well, the first thing you want to do is figure out if you should be making the pass-through entity election, and you want to do your best estimate of what the taxable income will be and who it's qualifying for. I mean, unfortunately, it's like tax, everything. You just do the best that you can, like you would with estimated payments or an extension payment. Another question that we've gotten is, did you say S Corps that make a PTE election should record state income tax payments as distributions, not income tax expense?
No, it's intended to be a tax expense for federal tax purposes. You do have to look at what the state rule says they are, and because really it's the state rules that are applied. Is it more like a composite tax payment? Is it more like an actual tax expense payment? Mm-hmm. So really, I think each state you're going to have to take a look at. Greg, have you had some of those situations?
Yeah, well, I was going to say, I think you're exactly right. That's how it's going to be treated. And everyone's going to need to look at in the case of a partnership, they're going to need to look at their operating agreements, see if they need to be amended. We may need to specially allocate, in theory, some of those state tax payments that are made. Within the S Corps, obviously everything should be pro rata, I presume. But as you noted, Sarah, everything comes down to state law.
It does. It does. All right. Let's see. Let's move forward on this because we got some more things to cover. Those are great questions. We appreciate your bringing them in. If we can't get to your question, we'll get it addressed outside of this presentation. So thank you for that. All right, let's get back to some more general things that have been going on. This has been another big year for M&A, merger and acquisition, transactions and activity. And so we want to ask you, have you thought about, your growth strategy and exit strategy? Does it involve an acquisition, a disposition, a sale, bringing in outside investors, changing ownership? Even our firm has gone through a transition and change this year. So even in the rather limited world of accounting and consulting services, we too have seen some of this activity going on. Very hot, very active. Maybe in 2023 it will settle down, but when you're talking about year-end planning, this is a great time to get that transaction. If it's already happened, get all those documents together. Let us look at what the results are, make sure that the projected gains or losses and expenses and everything captured together is going to report as you expect. In the same way, if you're not sure where you're going or what that may look like, or you're contemplating, now is a great time to settle back in and look at your options, and also get your documentation up to date. You're going to have a due diligence team poring over your records and over your supporting ledgers and work papers and everything. So this is a great time to be clear on what your tax accounting methods are, be clear on any issues you might have, not just income tax, but sales and use and payroll and otherwise, and get all of those cleaned up before you go forward into due diligence and what that can bring on. It will certainly save your people some time and effort if you can get this on when it's not so stressful in the middle of looking at a deal opportunity. On the same token, it's a great time to also look at your international operations. If you have ownership of or owned by an international company, or you're looking at those activities, particularly in a controlled group setting, let us be clear about what the organization looks like to make sure that all of the reporting is handled, because forms 5471, 72, all of those carry extensive and heavy penalties for failure to include them properly, to file them timely, to report correctly on them. Penalties grow very high very quickly in that area. The other is making sure, if you are engaged with transfer pricing, Henry, have you put all those transfer pricing policies into effect? Let's not wait until next September when we're trying to file an extended tax return to say, oh, wait, but we need to make our transfer pricing adjustments. Let's go ahead and get those into the records before year end and close the books with the right documentation and with the right transactions already recorded. Greg mentioned this earlier, the small business exception. Originally, it started with an average annual gross receipts for the past 3 taxable years of $25 million due to inflation step-ups. It's up to $27 million for 2022 and will increase to $29 million in 2023. So those that have annual gross receipts for the prior 3 years under that threshold can qualify for simplified methods, and that is exclusion from having to worry about the business interest expense limitation, can avoid the uniform capitalization, can avoid some complicated accounting for inventory, and also can use long-term contract methods, the simplified methods rather than a percentage of completion method. So very helpful to know where you stand and what may happen to you in 2023 if your gross receipts suddenly are higher and you looks like you will exceed that threshold of 29 million next year. What does that mean? So you could be prepared for it and be thinking now, how do I need to finish this year so that next year will not be a surprise to me. Another area we like to bring up, seems that every year the IRS is winning a court battle with a closely held business over how that business is compensating the owners of that business. In this case, we had a C corporation where they were paying salaries to the owners for their efforts, and then they were also paying out management fees on a Form 1099 at the end of the year. And amazingly enough, the management fees somehow zeroed out the income of the corporation each year and always seemed to be directly in proportion, not to services received from an owner, but to how much they owned of the company. So that's a big red flag to the IRS. And when it came to the court said, look, you taxpayer failed to document the services that you received for those management fees, and you failed to consider what is the right price to pay for those services. And therefore, this was really just a disguised distribution of the profits, and we're going to make you reclass that as a dividend. So what's the downside to reporting as a dividend? Well, in the C corporation, you lose that deduction they were taking for the management fees. So count that as a 21% tax rate on that lost deduction. And then you've just handed the owners dividends, and they have to pay 15%. And you say, well, they were paying 37% on the fees they received. Why is that so bad? Now they only have to pay the 15%. Well, again, you're dealing with two levels of tax, and there's not a way for the owners who were paid that tax. They're going to get a refund for rearranging this as long as it was within an appropriate time period. S corporations kind of face the opposite rule or opposite situation or similar situation. They may be trying to take everything out as dividends, and the service is coming back and saying, no, wait, those were not non-taxable dividends or distributions. That really should be additional compensation. You haven't paid yourself enough. So just to say, as we come to year end and companies look at their processes for trying to compensate the owners of the business, bear in mind that the IRS is always scrutinizing how closely held businesses are compensating their owners. Business meals and standard mileage deductions, some changes here for all of 2022. Business meals enjoyed at a restaurant, and that's a very loose term for restaurant, is 100% deductible. In 2023, that opportunity is repealed, and business meals will go back to only 50% deductible. Standard mileage rates, we saw, we started off the year at 58.5 cents per mile, and then in the second half of the year, reimbursement rate for business mileage increased to 62.5. Very likely that come January 1 of 2023, we'll see another increase in the standard business mileage rate. That rate is not usually issued until late December or early in January. Form 1099-K, this is more of an FYI, watch out for this. This is some of you may have received the forms 1099-K from credit card companies reporting out all the transactions on credit cards that ran through their network. They have to issue the 1099-K. There was a very high threshold for reporting, high compared to the current threshold, but that threshold for reporting dropped significantly and is going to be at $600 threshold, regardless of the number of transactions. So it's not even like, well, at least $600 in 20 transactions or 100 transactions. It is no, once that individual reaches $600. This, of course, is trying to capture all of the Uber drivers, the others selling goods on Etsy or gig workers through different online capabilities. It's trying to make sure that those payments that were made through credit card systems are showing up through some sort of reporting mechanism back to the IRS. It also applies to gift cards, not just the credit cards. So you may expect to see more 1099-Ks coming to you, which may need to be reconciled with your gross receipts, or make sure you capture that information. Or you may need to be thinking about if you're running your own gift card system or have your own in-house other kinds of systems that run through these third-party network payments, are you or someone else taking care of the reporting for that? That was a lot of words. All right, polling question number 3. Let's see. Did your company participate in an acquisition or sale of a business in 2022? Interested to see how much merger, acquisition, selling happened during the year. Yeah, so there was a question about on the case on the closely held C corporation and the management fees paid. Partnerships are a bit different, as Kat mentioned earlier. Your partners in a partnership do not get W-2s, but they will get guarantee payments or the income distributed to them if they're providing services to the organization is likely subject to self-employment tax. So it's a slightly different sort of circumstances when you're dealing with partnerships than having a corporate solution where you would have W-2 earnings and or dividends, a different kind of distribution out of the company itself. All right, looks like about 25% of you had some sort of activity going on this year, which is great. And others say, no, not yet. And moving forward, good. All right, Greg.
And Sarah, just to add on to your comment about the LLC.
Yes.
The only place where I've seen the service have some issues there is if you're doing a management fee between related party LLCs and or S Corps where they have different fiscal year ends. So that's certainly something to consider. Does it have the look and feel of a tax strategy? If so, there could be issues there to address if you've got fiscal year ends. With that, we'll go on to some final reminders and a little traditional planning. This will be the final section for the webinar. First reminder is if your company deferred payroll taxes in 2020, you paid the first half last year, your final payment is due the end of 2022. So ensure you don't miss that final payment of that 2020 payroll tax deferral. As we go into year-end projections and we start to plan for 2022 final payments, is the company projecting higher profits and theoretically higher taxes in 2023? If so, do we want to try to accelerate any income back into 2022? This could assist with any of the loss limitations that Kat mentioned, and it could also help us utilize some of those lower tax brackets. One of my favorite subjects to have talk about with clients this time of year is, have we already started to talk about the plan for extensions and or timely filing the tax returns? Love to remind everybody, January to April is our busiest time of year. Certainly scheduling all of your work now is ideal. January is our slowest month, so please do us some favors. Let's pull that work into January, if at all possible. Some standard business tax planning is looking at all of our receivables before year end. Can we deduct any of those bad debts this year? Companies love to acknowledge when there's a theoretical chance that it's partially worthless, and they like to put a reserve on it. At the end of the day, we won't get a tax deduction if we just reserve those receivables. We have to completely write them off for tax purposes. That is going to generate us an ordinary deduction if we've got a business bad debt that becomes wholly worthless or partially worthless, and we do write it off. For all those non-business bad debts, it's going to generate a capital loss. Another option, we can consider abandoning business property. a lot of times, you really don't want to do this unless, you absolutely need to, or you feel that it doesn't have value at the end of the day. You do have to irrevocably disregard it. You have to have affirmative action to show that you did abandon the property altogether. A lot of times these aren't perfectly documented, and that's the most important thing in this case, is to document and show that you had affirmative action for the abandonment itself. Where I usually see it's not documented as well as it could be is when we're abandoning partnership interest. You definitively want to write a letter to the partnership, acknowledge that you're abandoning your interest altogether. Now, when you abandon business property, that's going to be an ordinary deduction. If you do abandon partnership interest, we need to be careful. We need to take a deep dive alongside you to determine whether you're going to receive ordinary deductions or whether you'll have a capital loss from that abandonment. Two big things to look at before year end if you have real estate. Consider whether you have a partial disposition, if you've done any build out on any of your buildings, and also go ahead and take a look at if you have tenant space and a tenant actually vacated, whether or not you can write off those costs. If you need assistance, your cost segregation team can assist if it's large enough, but you will need to know your 7 component parts at the end of the day to do a partial disposition. So here we've got some kind of standard steps or items we like to look at before year end in order to lower our taxes. Obviously, if we're doing any fixed asset additions before year end, we can accelerate those based on the 100% bonus depreciation and or claim Section 179 expense if we're profitable. If you're considering accelerating charitable donations, that's absolutely a good way to do it. If you're not sure what charity you want to give it to, you could consider a donor advised fund. This is where you can set up one of those funds, ultimately fund it this year, take the deduction, and then push that cash out to charity in future years. You can accelerate any of your deductions by theoretically, if you're under the cash basis, paying any accrued liability that you have due before year end. If you're on the accrual basis, you could consider adopting a 12-month rule for prepaid expenses. This could be a change in accounting method, something definitely to review alongside your CPA. If we're going to do bonuses to any of our owners and or S Corp shareholders, we want to make sure we get those paid in before year end.
So Greg, I frequently get questions about this bullet point to decelerate revenues. And folks often say, well, wait, I'm an accrual basis taxpayer. There's no way I can do that. But it really means looking at when is your revenue actually recognized. If your revenue is not earned under your contract with your customer until the customer actually accepts and approves the good that you've delivered to them, well, then there's your point for recognizing revenue. Is it good as soon as it leaves your loading dock or is on the truck for delivery? Well, there's your point for revenue. So thinking very holistically and finally about when is the point in your activity stream when the revenue is recognized. And many of you have probably been through this conversation with your auditors if you have an audit report under the GAAP rules for revenue recognition, and just being clear about when that is and what steps can you take, if any, to shift that action to a point where you want it after year end or before year end to make sure that you're recognizing revenue or having the effect such as you can on your revenue recognition. It's a little easier with cash basis, not that you can not open the mail, but maybe don't send the invoice yet so that you would receive a payment by year end on there. But always bear that in mind, that the company operations always overweigh and outweigh tax decisions at any point in time.
Yeah, and Sarah, you brought up my favorite topic on the deceleration on the revenues for cash basis. Checks in the drawer are deemed received. Those are revenue. So very rarely are we trying to increase taxes, but ultimately sometimes that is the strategy. It's definitely worth looking at. These are just a few ideas on how, in theory, we could increase your taxes If we want to go ahead and change from cash over to an overall accrual method, that will usually increase our tax base. If we've got inventory, we could consider changing from lower of cost or market over to cost. For a lot of auto dealerships, considering a change from LIFO to FIFO. And one that's highly likely going to increase your taxes is you could consider a change of tax entity. If you switched from an S Corp to a partnership, ultimately that's going to trigger any embedded gains that you have within that S Corp.
So all right, I think we're up to our fourth polling question. And Kat, will your company take actions before you're in to lower your expected tax? And Kat, did we have another question in the question pod you wanted to bring up to us?
We do. A clarification. It looks like somebody, I wasn't listening as carefully, but the 45L credit is $2,000 right now through 12/31 and will be increasing to $5,000. It looks like it may have been set as $1,000 potentially. Okay, so did you say that commercial companies can get a tax credit for adding charging stations for electric vehicles to their location?
That is what is intended, but I will defer you to our energy credits team to clarify all of the details in that associated with that credit.
And then as far as the management fees go, when we were talking about, zeroing out taxable income via management fees, they asked if that also applies to LLCs.
Right. And the situation is slightly different. But yes, anytime you're trying to wipe out income in a partnership, whether you earn it or whether you distribute it or through a guaranteed payment or ordinary income, it's going to be taxable to whoever is to that partner that receives it. So not quite the same situation for an S corporation or a C corporation, but still, anytime you're talking about compensating for services or just distributions out of operations, that certainly has a situation that warrants looking at for potential that the IRS may scrutinize it.
Yes.
Great. All right. Looks like the polling question, many of you are going to find something to do to help lower your taxes before you're in, and that is fantastic. So Maddie, I'll let you close us out with any final words.
Yep. Thanks so much, Sarah. Thank you, Greg and Kat, for all the insight today. If you guys do have any questions following this presentation, the contact information for Kat, Greg, and Sarah is on the slide in front of you. Just a reminder, we will be sharing a copy of the recording in a few days on our website and in a follow-up email. And the last note is, as soon as this session ends, a survey will pop up. We value your feedback and ask that you take part. Thanks so much, everyone. Enjoy the rest of your week, and we'll talk to you soon.